All right. Well, this is a very slow day, of course. The market's down. Um, the market is okay. So we can start by looking at some pretty important factors in the stock market. One is interest rates, and one is oil. And I wanted to focus on those two things because the price of oil is really, really important to what people actually pay for stocks. Believe it or not, it could be like almost a one-to-one correlation. So I'm going to go over where we are right now. We're at the end of March. Um, we have holidays, and usually when people come back from holidays, we have a decent, people are refreshed and they're ready to buy stocks. But we are um, in the middle of a super extended um, stock market going up, and like this has never happened. This hasn't happened since for like 50 years, where we have how many weeks of stocks and it's overbought. So this doesn't happen every day. Usually, you can see for the past couple years, we have some ebbs and flows. We have some down, oversold and overbought. It goes up and down in this channel. But now we're staying overbought. Um, that's that's like there's a saying: stocks take the stairs up. It's like taking stairs up, and then it goes down like an elevator. So you have to be ready for that if you're a long-term investor. So I know a lot of things that I own right now are overvalued. That means their peg ratio is more than one. Um, they seem like they're overpriced, and you have this mania or euphoria in the markets. And the problem is, as a beginning investor, you think, oh, it's going to keep going up. It's going to keep going up. And you don't want to pile on. If you're here, you don't want to borrow money to buy more because, it's a pretty dangerous time right now. So, okay, that's a good thing to think about. Let me see. We're getting into April. April is one of our best months of the year. You can see March, April, and May are traditionally good months. And there's a lot of theories why that is, but we do have earnings coming out. You can see in our timeline, tech earnings are coming out in the last week of April. So that's why I have green on our calendar. And all right, so let's look at some of our notes for our meeting. We had a 10-year and a 2-year down 1%. The one thing that's interesting is the price of oil is unchanged, but it is going up in general. So I've been saying this for a long time. High oil is inflationary. If the price of oil goes up a lot, there's a lot of reasons for oil to go up now. There's a lot of geopolitical issues. If this goes up, that's really bad for the stock market because that increases the price of all items, most items made in America and around the world. So if we see this, this was like 60 last year, but if this creeps up to 90 and $100 a share, inflation is going to go up, and then the stocks go down. So that is pretty bad. But we'll keep an eye on that. And it's very important. If you see this price of oil going up, then there's a very good chance that people are not going to pay as much for stocks. We can see from this momentum indications the amount of S&P above the 50-day and 200-day moving average is over 80% now. That is a sign of a bull market. People are super excited. That matches our stochastic charts where people are expecting higher highs. For me, whenever I see euphoria in the stock market and I see 80% of stocks above their moving averages, it's a sign that I'm not going to be selling, but I'm not going to be buying right now. It's just a very difficult time to buy. Warren Buffett's not buying because he doesn't see any bargains and he's waiting for a correction. All right, so let's see. All right, so our theme for this year is return to the mean. Healthcare, telecom, and financials and biotech are actually breaking out. They are actually doing really good now. And now the tech stocks are starting to go down. And so it seems like what could happen is if there's a return to inflation this year and it gets a little out of control, people will gravitate towards safe things like healthcare, telecom, financials, anything that has a yield. And utilities are actually starting to outperform now. So our worst at first is actually coming true. Let's see what else is happening here. Okay. Okay, so S&P 500, we're kind of stuck right now we kind of have two different angles to look at. One is this long-term angle and one is a short-term. And we're basically stuck right here. There's a very good chance that we'll be going back down to here before the middle of next month. So let's watch that. We're overbought. And that's all we can see from that. We can still see the for a long-term chart, you can see there is a correlation. When the interest rates go up, the stock market goes down. Lately, that hasn't been working. Actually, the stock market goes up regardless of interest rates, because you can see that in interest rates we have a pattern where they're actually going up. There's lower highs, lower lows, and they're going up. And the stock market's going up too. So it's not necessarily an inverse correlation now. Let's see. Okay, fear and greed index, we're getting less greedy. Right now it's actually greed 73, not extreme greed. That was 76 last week. So we're getting a little bit more cautious. And people are kind of scaling back a little bit. People are more, hold on for a second. Let me get to the right spot. Hold on. Okay. Actually, I goofed up. Okay. We're at greed right now. So we're at greed. It was extreme greed last week. So we're starting to scale back. People are starting to get a little more cautious. This is usually whenever people go from greed to extreme greed to greed, then it'll be down to fear maybe the beginning of next month. And then that'll be a time to buy, but not now. All right, so let me see. The sentiment, AII sentiment, it's more bullish, 7% more bullish this week than last week. So the average investor is piling on. They're borrowing money to invest. They're buying calls. They're doing all kind of speculative things. And that's kind of dangerous. Let's see. Okay, the US dollar isn't doing anything right now, so that it's like in a sideways pattern. It's still continuing that. See, the VIX is pretty much at lows, and it's kind of stuck in this range. That means people are not fearful, and that's an indication the bull market's going to continue. And we're still excited in the stock market. The only thing in the way of the stock market going up is the U.S. debt and the Treasury rates. Let's watch that and see if it stays the same where it's at now. Okay, the PE ratio for the S&P is 23 now as of today. That is really high. And the average is 15 or 17. So that's like 25% less than where we're at now. So don't be surprised if we return to the mean, which is a 23% correction from where we're at right now. Let me see. Okay, this is our first to worst. At the beginning of this year, we were looking at all the sectors that did the best last year and the worst last year. And we looked at how they were going to turn around this year. And it's actually happening, believe it or not. We just had utilities go up 5% in the last week. Energy is up 13%. You can see it was down 4% last year. And healthcare is up 8%. And you can see that the IT and communication services like Facebook and Google, they're kind of not going up now. They're starting to go down. And consumer discretionary that was up 40% last year is only up 3% now. So we do have a worst to first coming into play. And if inflation goes up more, and it stays hot and the oil price stays high, then you'll see this magnified. All these will do much better, the ones that did worse last year. So let me see. We're still watching the AI revolution. No one knows what these stocks are going to be earning because it's almost like the infancy of the internet. No one knew what the internet was going to turn out to be, but they knew it was life changing. So I've been invested in some of the AI stocks for a long time. So it doesn't change my thesis. I'm not going to be selling out of them right now, but it's just an added bonus for those stocks I'm involved in, like Microsoft. Okay, weight loss is another thing we're watching. What are the things? Okay. Okay, we're starting to see mortgage housing prices go down like 20%, which is pretty interesting. They're expecting rate cuts, and that'll help the housing industry. Okay, that's all I have for that. Let's look at Dan Now's picks. Amazon and Meta are continuing to do really good. XBI, his biotech stock. That's biotech stocks. They're very small cap, and they don't have profits yet, but they're doing good because they've been out of favor for 3 years, and now they're starting to be in favor. Texas Instruments, that hasn't gone up with the other semiconductors. And KWeb is still bad, but it's coming back. It was down 12% before. So let me see. All right. So I picked out some charts that were interesting because I do the stochastics every week. If you look at the XLU, this was one of the worst performing sectors of last year. It's utilities. The reason why utilities were doing bad last year is they need to borrow money heavily in order to fund their operations. They need to build new electric generation utilities and things like that. And as interest rates go up, they're heavily penalized for borrowing money. But now you can see, just in this last week, it's starting to break out of this downward channel. And it's actually one of the better performers this year. It started the year right here, and it's up 4% now. So I'm expecting this to outperform as interest rates go down, because the interest rates go down, companies that have yields, or companies or sectors that have yields, will go up. All right, so we're going to keep our eyes on that, the XLU. The XLE, we noticed way back in the middle of February, it broke out of this downward channel, and it's starting to be one of the best performing sectors this year. And this is like almost a direct correlation to the price of oil. So as the price of oil goes up, this will go up with it. Let me see. So if you own any stocks in the oil industry that you want to eventually get rid of, or if you're not interested in a certain sector, say if you have healthcare, a sector, you want to get rid of some stocks in that sector, keep an eye on the index for that sector, like the XLE, and you can see that it's not a good time to sell the oil stocks because they're in an uptrend. All right, Google. Remember at the beginning of March, we saw the perfect combination. where we had oversold condition, and whenever you have an oversold corresponding with the bottom of the channel, that's a really good indication that you have support right there. And we're actually at the top of this range right now for Google. So it's not the time to buy Google. It's overbought, but it gives you in 1 month how a stock can go from oversold to overbought. And this is one of the most, it's one of the most consistent stocks we're following in an uptrend. And that's because a lot of people watch it. And it has consistent earnings. You're not going to surprise that much. They're growing at 14%, and they're pretty consistent, what they have to offer. Right now, the biggest problem for Google could be antitrust resolutions. If they're forced to unravel some antitrust bonds with Apple, like if they don't get their search agreements with Apple, or they have to split up their Android and give it to other people, or whatever it is, that could tear apart the company. The other thing with Google is they're a little bit behind maybe in AI, and some of their demos didn't go over very well. So there's a lot of PR issues with Google, but their numbers are still showing that they're growing at 14%. Hi, Mark.
Hello.
What's on your mind? Do you have a topic that you want to cover today?
Well, you were talking about utilities. I have Spire as well as Amber. Those have been good dividend ones for our family for years and years. So it's nice to see growth too.
Okay, Spire, they're like the natural gas company, right?
Yeah, Spire, I mean, we've known them since they were electric gas, and Amber, we've known since they were Union Electric.
Right, yeah. So utilities are traditionally, they don't grow very much. They grow like maybe 3 to 5%, and that's probably because they're regulated. What they can charge to customers is totally has to be approved. Any rates they charge have to be approved by commissioners, and they traditionally yield a higher amount, like 3 to 5% maybe, and so they're consistent. If you want a consistent 3 or so percent in your portfolio, you would own utilities, but they're not going to be stellar performers. They might even break even or just not do anything for a period of time, but at least they pay yield. The one problem with utilities, especially in California, they have some liabilities, potential major liabilities, because utilities don't put their cables underground. They put them on these. They had
the big fire.
Yeah, if you have fires, that could crush your company. I think that made P&G, I forget the name of the company in California, go out of business.
Pacific something.
Yeah, I think it's even though it's consistent, you have a consistent amount of money coming in for the company, you have an intangible amount of payouts if you have a problem with a fire that they caused by their wires. So that's like one reason why, that's like a wart of that industry, that it's kind of hard for me to invest in a company that could potentially have such major liabilities. I don't know. Okay, so but if you have a situation that's pretty much under control, like in Missouri, you don't have a whole lot of it's not that hot. In California, you have a desert with, if you spark just a little bit, it starts burning. So anyway, yeah. So Google has been one of the most consistent stocks we're following, but it's super overbought right now. If you have a big position in Google like me, I guess it's a good time. This is a good time to start selling some, because it's a good time to sell. I'm not buying. Okay, Pepsi. I just noticed that we've been in a downtrend for eons, at least a year. And all of a sudden, this is an example of some of our higher yielding stocks breaking out. As the interest rates go down, some of the more conservative stocks, like dividend paying stocks, are going to be more desired. So you can see a lot of the dividend stocks in our portfolio we're watching are starting to break out into these channels going up. You can see, like, let's look at another one, like Philip Morris. Hold on. Okay, Philip Morris. No, this is Altria. You can see it's in a downtrend for like maybe a year or two, and all of a sudden, it's becoming one of these stocks that are starting to be back in favor. So you can see most of the dividend-oriented stocks, like utilities and telephone companies that pay large dividend, they're starting to break out like that. I think AT&T is another one of those stocks. Mark, you were absolutely on target whenever you were buying AT&T. Let's look at AT&T. Look, there it is. Right here, Mark was saying, but what about the dividend? And that was yielding, what, 10% back then, Mark?
Yeah.
Okay, so you can see, if we would have been tracing interest rates, and we knew that interest rates would start the cutting this year. Perhaps next time that happens, and we know that's going to happen, we should get into some more higher yielding stocks. You can see Verizon is very similar. It was in a downtrend forever, and you can see this is the downtrend, and basically around November, it started the uptrend with like the Philip Morris, not like the Altria and AT&T. So all the dividend stocks that were underperformers last year are starting to be performers now. You see. All right, so Pepsi is an example of one just starting to break out. I've had Pepsi in my portfolio since 2000 or something like that, and it just seems like it's they have very high margins, because they make their potato chips for 10 cents and they sell them for $2 a bag. That's where most of their profit comes from, I think. I think half their profit comes from Frito-Lay, half of it from actual beverages. So they're a very diversified company. But right now is like, if I didn't own Pepsi and I wanted to keep it for 20 years, this would be a good time to start looking at it. It's either in a sideways pattern like this, or it's starting an uptrend. We don't know. And that's all going to happen pretty soon. Okay, here's another little indication. I have so many red flags flashing at me that there is a top in the market. We have had meme stocks like Donald J. Trump going up 40% a day. We have there's this indicator from Warren Buffett. He says probably the single best measure of stock valuations. It's the earnings of the S&P compared to the GDP, and Warren Buffett came up with this like 20 years ago. Perhaps that was before maybe there were international companies that did most of their business overseas, because I guess if you redid this today, you'd have world GDP versus, maybe the S&P 500 earnings. But right now, there's an indication that this John Hossman says we're at one of the most extreme speculative bubbles in U.S. financial history. And this guy predicted a crash in 2000 and 2008. There's other people ringing in, and adding to that, saying that there's a melt up and it's being ignored by investors. The market continues to march relentlessly higher, and no one's going to call a top. That's what I've been saying for, basically all year. You can see that. Let's look at the S&P. It's just a relentless, never-ending going up, and trees don't grow to the sky. So we just have some very smart people right now saying, "Don't get over your skis," and we could very easily correct 15%. So what you have to do, if you know that things are extended, you just can't buy on margin. You can't buy really speculative things with high peg ratios. What Warren Buffett's been doing, he's been buying stocks with a PE ratio of 6, like HP, Hewlett Packard, and he's been very cautious in what he buys. And I guess the most expensive thing he owns right now is Apple, and it's like 3 times overvalued. So let me see. Okay, there are fewer questions about why the market is going up than there are when it trades down. That's what Louis Navellier said. In JP Morgan, that company's been saying we're due for like a 15% correction in what they're saying. So anyway, that's just something to keep in mind. Here's an example of froth in the market. Whenever I say that we're going up and we're frothy, we're very irrational in a way. We have this Truth Social. The numbers on this company are just so ridiculous. It surged 56%, and it went up 14% every day this week, basically. And it was just nuts. You guys have to stay away from this. It's been classified as another meme stock, like GameStop and AMC. Look at the numbers on Truth Social. They had just 3.4 million of revenue last year, and they lost 49 million over that span. So they're losing money. They can't make more than 3.4 million a year, even in their best year last year. And they're valuing the company, 11 billion or more right now. So you just have to stay away from this kind of stuff. It's just nuts. And there could be a lot of people, a lot of Trump followers that want to help Trump out, and you have 40 million people that are voting for Trump. Maybe they'll help the stock go up, but it's just what'll happen is eventually it'll just go back down to where it's really worth, which is almost nothing. Here's an example of an IPO. Reddit, they have a very similar situation. They're not profitable yet, and they went up 25 a lot the first day of trading. And now they're below where they started trading at. So it's you just have to stay away from this kind of stuff. Anyone have any comments on this? All right. Right. So seeing that we don't have a market that's active today, I thought it'd be interesting to talk about tax brackets and how what you can do now to help your tax situation. So what I did was I looked at what the current tax brackets are, and I took out an example for just one of these tax brackets, and I made an example of how to do some last second tax moves to help your taxes. So I guess the basics of taxes, if you don't do them already yourself, you have different, based on how much you make, your total income plus what you make in the stock market, etc. It falls between these brackets, then you pay a certain amount of tax. 24% of your tax is paid. And if it's in this bracket, then you pay 32%. So that's a difference of like 8%, which is pretty big. That's like $8,000 for a $100,000 portfolio. So it's in your best interest to try to get how much you make, that final gross income, to be in a lower bracket. So if you were in a bracket that was like maybe 96,000, if you gave some to your IRA, you can easily go down into this bracket and pay 2% less in your taxes. And so you can, so what I did was I put together some examples of marginal for a single individual. So what I did is I said, if we have a $100,000 W-2, and so we would normally be in this tax bracket, we pay 24%. Right now, you could actually make an IRA contribution. The amount that you can make is $6,500 if you're under 50 and $7,500 if you're over 50. So let's say you're under 50. You can make a $6,500 contribution to your IRA before you file your tax, even now, before March 15th. And the amount that you'll owe is less if you contribute to the IRA at the last second. And on top of that, if you have any stock market losses, you can deduct those losses from the total amount of your income, and that's up to $3,000 a year. So the total tax in this example that you'd have to pay taxable income is $90,500. So that means you'd fall into 90,000 falls into that tax bracket. So you can see by putting money into an IRA, you can actually reduce the amount that you pay by 2% in this situation. The next example is, let's say if you're in this tax bracket to begin with, and you want to do a Roth IRA conversion. So that's another thing that you could do. Whenever you convert, some money in a Roth conversion, it's treated as income that is your income. So if you make $80,000 a year and you convert $14,000 from a regular IRA to a Roth, you can actually, the amount here that's the total taxable income will be right at the edge of this. So you'd still be paying 22% tax bracket. And that's an example of maybe every year you do a little bit of a Roth conversion. You want to make sure that you don't do enough of a conversion that it puts you in a different tax bracket. Or if you do, you want to make sure that you don't go into this tax bracket. And these are some last minute things and you can also donate to charity, but you have to do that before the end of before the end of the actual year. And so if you donated to charity, like if you donated $10,000 to charity before December 31st, you would subtract that from your to get how much taxable income. So they're making it harder to donate to charity because they have such a large standard deduction now. It's something like $10,000 or $20,000, and you got to donate more than that to charity for it to help your tax situation. Any questions about that? All right. Okay, so I like to follow Bill Ackman. He's been pretty good. He's a really smart guy, and he's over time he's done really well with his hedge funds. He has 70% of his 10 billion portfolio in just 4 stocks. I thought that was amazing. Just 70% in 4 stocks. So he must have a lot of confidence in these stocks. We're actually following CMG, which is Chipotle, and Google already. So I'm not going to go over them today because we know Chipotle is growing like 18% a year regularly. They're very expensive, and Google, they're like 3 times more expensive than their growth rate. Google is actually fairly valued, and they're growing at 14%. And what I thought would be interesting is to go over these 2 other stocks that he has, just because they're out of the ordinary. There's not something that anyone ever comments on in on TV or anything like that. Why would he buy Hilton and QSR? Mark, would you have any idea? QSR is actually the chain that owns Burger King. A lot of the, let me see, what do they own? They own Tim Hortons, Burger King, Popeyes, Louisiana Kitchen, and Firehouse Subs.
I have no idea on that.
Okay. Why would he buy Hilton?
People are traveling again.
Yes. Okay. So perhaps he bought Hilton, way back whenever people didn't have confidence that we'd get out of the COVID mess. And QSR could have been timed around that time too, because people weren't going to restaurants. But right now, there's a return to travel. People are the airlines have TSA reports they have an extreme demand for air travel. So we have all these things that are helping out this hotel industry. And for QSR, there's the one problem with restaurants now is the low-end consumer, like to go to McDonald's, they're being pinched and they're making their meals at home now. There's kind of, because McDonald's is kind of suffering from that. And so we have a little bit of pushback from customers due to inflation. So that's one problem right now, but that's only temporary. Okay, so let's look at so the thesis we know for Google is they have a 95% market share for search. It's going to take 10 years for the government to break them apart. While that's happening, Google's going to make 14% until they figure out how to break them up. And of course, AI, it's going to take 5 or 10 years for people to switch from using Google to using AI. So at least you have 5 years before Google starts losing business. Chipotle, they have a very educated, high-income customer that's the fast casual, and they have a consistent, good product, and they charge a lot for it. But they're growing 18%, so let's look at how these other two companies stack up. QSR restaurants, they're actually growing at 12% if you average out for the next couple years. That's pretty consistently 12%. And their PE ratio is only 16. So if they're growing at 12%, that's a PEG ratio of 1. So they're 30% overvalued right now. But this is a really low number for this industry. I mean, I think Chipotle has a PE ratio of 50 or 60. McDonald's is higher PE and a higher PEG ratio. So this is kind of like a fairly valued company. This is the kind of company I would wait for the PEG ratio to go down to 1 before I would look at it. I'd rather have a margin of safety on it. So let's see. It doesn't excite me though. The whole restaurant industry. It's the fast food industry. Okay, let's look at the statistics on this company. Their 4 PE is only 16. Their return on equity is excellent. It's 40. Usually 13 is our minimum. And profit margin is 17. We like to have 13 or better. So that's all looking good. They don't have a PEG ratio for some reason. I'm not sure why, but that's like an anomaly. I'm sure it's okay. Let's look at Hilton. Hilton, they're actually growing around 15% if you average all these years out. And so the PEG ratio is 2. So you're paying a really big premium for this company. Let me see. Okay, but it's very consistent growth. I wouldn't expect a company this big that's like a hotel company to be growing at 13%, but they are. Let's look at the numbers on. We see. So the PEG ratio is 2. So if their PE is 29, they're growing at 15%. That divide those, and you get 2. And Yahoo Finance thinks that they're actually growing at 30%. I didn't see that, but they say the PEG ratio is 1. Again, we don't have a return on equity for some anomaly. So it looks kind of sketchy to me, this one right here, this Hilton. I'd wait for another pandemic to buy this one. But at least we'd have like an overview that, there's still demand for what they're selling. I wanted to check in with Tesla. Tesla's been in a super downtrend. Let's look at the stock chart right now. Okay, you can see this. I think this all started whenever Tesla last year to this year earnings is a negative 7%. So if you divide these 2 years from last year to this year, their earnings is negative 7%. Then they're supposed to grow around 20% a year for the next couple of years. So there are people there are very smart investors that are saying that they're selling a razor blade model. They're basically selling their Teslas at really cut rate prices. They keep reducing the prices. They're giving people the razor, and then they're going to be charging monthly subscription fees for self-driving and other features. So if that's one thing. The other thing is the possibility of full self-driving robotaxis. And if that whole thing happens, they could be turning into a taxi company. But as you can tell from the chart, people can't see beyond this current earnings problems they're having. And they have problems with China, where they're not selling as many cars in China either. So let me see. I don't know. It's kind of sketchy right now. They have a PE ratio of 56. That is really high. Their PEG ratio is 3. So they can drop to like 70 or 60, and they'll be fairly valued. So this is definitely you don't have a margin of safety with this company. You really have to count on them selling things other than cars to for them to be profitable in the future. I don't know. It's Mark, do you have any ideas on this one? That's a no. All right. So okay. So it's in a downtrend. You can see it's at the bottom end of their downtrend. You can see it hit the low stochastics, and the next stop is probably right here, and then down here. It's turned in from one of the Magnificent Seven to, okay, we're throwing that out of the Magnificent Seven, and it's not a magnificent stock anymore. It's pretty dangerous, especially if it's in this downtrend. I guess if you're interested in this stock, you have to wait for it to break this channel, like right there, and then look at the earnings and see if that's improving at all. Okay, let's look at the statistics on Tesla. They're now a $500 million company. Their forward PE is 56. According to Yahoo Finance, they're growing at 25%. So that makes a PEG ratio of 2. That matches a little bit about what we're doing. Profit margin is good, and return on equity is good. But right now it's very speculative, because they have a lot of products that may or may not work, like the subscription model to self-driving cars. So we'll see. I guess one of the most valuable things that this company has is they have millions of cars driving around and just training their AI models. So maybe somehow they're going to use AI in their full self-driving feature to charge people by the month. We don't know that. We'll see. And also, we also have the bonus of people adopting their standard for charging. So if they're able to sell energy, they'll become an energy company, and they'll be selling the cars. So it's like a razor blade model, where you sell people the fill up your tank with energy, and self-driving service every month they pay $200 for self-driving mode. So, but that's not the numbers right now. Right now they're only growing at 20%, and they're 3 times overvalued. So we'll watch these numbers, and maybe every 2 months we'll check in to see if that changes. Right now it's too speculative for me to be interested in it. All right, that was a good little excursion. I thought it'd be interesting to go over Apple because it's one of my biggest holdings, and I'm really watching this like a hawk. Right now, it's only growing at 8%. If it's growing at 8%, it's consistent 8%, but it's 8%. Its PEG ratio is 3, so it's 3 times overvalued. The PE ratio of 26. It's a premium to the stock market. The stock market's at 21 PE. So we've been saying for over 2 years that this is an expensive stock, and I guess this year it's kind of coming down. It's in a trading range right now. Let's look at the Apple stock, the chart. Okay, you can see it's in a trading range right now. It's just it's stuck in this trading range, and it's at the bottom end of its trading range right now, but it's still overvalued. If it breaks below this, like down to here, then the next stop is like maybe down here. There's a lot of people following this because it's a common stock. So, I don't know. It's kind of sketchy. All right. So let's look at the Apple statistics. This, the forward PE is 26. According to Yahoo Finance, they're growing around 13%. I didn't see that, but their PEG ratio is 2. Their profit margin is really good. That's most likely because they have services as a good portion of what they make. So services, Apple Store, the App Store, or things like that, that allows them to charge, to make more profit on what they sell there. Return on equity is 154. That's higher than most stocks we follow. And Warren Buffett still owns this as half of his portfolio. So that's pretty impressive. But they're only growing at 8%. So if we do have a stock market correction, stocks that have a high PEG ratio go down more. So this has a PEG ratio of 3. In a really big correction, it might go down to 1.5 or something like that, like in half of where it's at now. So if you want to prepare for a stock market crash, you want to buy stocks with PEG ratios around 1, and that'll help you have a margin of safety. Okay, this one guy named Larry McDonald, he predicted the fall of Lehman Brothers and the crashes of 2000 and 2008. He said price of oil is likely a candidate that could rebound in inflation. So that means as the price of oil goes up, inflation will go up. It's like a 1-to-1 correlation. So if we go up $20 in the price of the oil, it could wipe out a bank because the interest rates will go up. And that is one of the biggest problems we've been watching that could make the stock market crash. And a lot of regional banks have a lot of long-term bonds, like the one that Silicon Valley Bank crashed. I mean, they got taken over last year because of that problem. We know Charles Schwab has that issue, a couple other regional banks. So we'll be watching this as as the price of oil goes up. That'll make the stock market go down. He also said there's a massive financial tightness on the consumer, so that'll affect all the restaurants. People won't eat out anymore. If you have problems like that. So as the price of oil goes up, the restaurant stocks will go bad. Will have problems also. So that price of oil is more important than we really think. Okay, so that could trigger a recession. So if the price of oil goes up, that could make a recession. Whenever a recession happens, the stock market goes down like 10 or 20%. So anyway, there's a lot of people that are perma bulls, perma bears too. This guy is neither. He just, whenever things are out of the ordinary, he says something. All right. So I think that's all I had to say. Anyone have anything you want to talk about? Any comments or topics or anything like that?
I'm good.
All right. That sounds good. All right. Well, thanks for attending. I hope you learned something, and I hope you have a good weekend and have a great holiday.
Yeah, you too.
All right. Talk to you later.